Hi and welcome to my channel. For those of you, my name's Dave and I work in financial services, and these videos will be a mixture of my journey and development towards financial freedom, and will track my development moving forwards. So it will cover my ISA account, my SIPP account, and videos will be about investment products and how they operate, and it will also be about improving your financial well-being so hopefully people can reach their financial aims and goals moving forwards. Remember, if you like the videos, smash the like button so this channel can grow, reach a wider audience. Now let's get on to this week's video. Now this latest video is about my self-invested personal pension. Now it's not to boast or brag, it's more about my journey and the aims for the portfolio moving forwards. So the plan is to make a growth rate annual return of 10% a year. For 2021, we're looking for receive dividends of £3,000 this year and a year-end value of £90,000. So if we look at the valuations, start of the month it was £90,423. The end of the month it was £90,075. Our first loss for this year to date of £348. For the end of June we were up 23.77%. And the end of July we were up 23%. So a slight shortfall, hence the loss for this month, but much better than our expectations of 10% for the year. Now, in relation to the month, we've made contributions of £100. We received tax relief of £25. We received dividends of £796.71, and they were from the following companies: AJ Bell, £6.42, Sainsbury's, £80.69, and we reinvested and got 27 new shares, and we have a special dividend from Penning Group, the water company. They gave £710 as a special dividend, and they reduced our shareholdings from 200 to 133. So for the year to date, dividends of £2,262, and the portfolio has given a yield of around about 2.72%. Now we would charge fees from our provider for the month, admin fees of £13.79. And if we look at the following chart, give an overview of how our portfolio is invested. So predominantly financials in the UK, 48% is in financial companies, 18% in consumer defensive, 9% in consumer cyclical, 7% in utilities, and 6% in technology. Now at the moment, 85% of the portfolio is in the UK, 12.5% is in America, and 2.5% is in Asia, of which 79% is in shares, 64% is in the FTSE 100, 15% is in the FTSE 200, makes up about £71,000, and 21% is in funds, making up £19,047. Now, if we look at the following graph, it will give us an illustration of which shareholdings we buy within the SIPP account. So, an overview. So we hold 17 shares at the moment, 10 in profit, 7 in loss. Okay, now a quick run through. Not going to go through all the shares, but just an overview of our biggest holdings. So our biggest holding is Aviva, £15,465, 17% of our portfolio, but a very good company, has been on a reconstruction lately, and hopefully will give good results and improved dividend next month in August. Our next holding is Lloyds. We own £14,287, 16% of our portfolio. Did have some very good results in the interim of the month, and it did reinstate a dividend 0.67p. We were hopefully expecting for a lot more, but it will give us a very nice dividend during the month of September, which we will reinvest in that company. Our next holding is Greggs. We own 266 Greggs shares, £7,328, 8% of our portfolio, and results will be due next month, hopefully, somewhat recovery in the UK. Hopefully the dividend will be reinstated, but up so far 128%, so a very good performance, doubled our money since we bought it. We own Barclays shares, 2,797 shares, £4,888, 5% of our portfolio, and again during the month of July some very good interim results. Dividend was reinstated of 2p a share moving forwards, but hopefully the banking sector will recover and it will give much better growth, much better dividends in the years to come. And then our fifth biggest shareholding is Drax, the power plant, makes up 5% of our portfolio. Again, had very good interim results. The dividend was increased from 6.5% to 7.5p a share, but it has been on a recent buying spree and hopefully will greater profits and greater dividends moving forwards. Now we're not going to go through all shares, but just a few shares of notes. We own Morrison shares. Okay, at the moment they're worth £2.72. Against the buying price, there's been an offer price of £2.54. Now they have got potentially a bidding war. Other companies have till the middle of August to make an offer, so hopefully we may get an improved offer and some kind of bidding war. We own shares in Royal Dutch Shell and BP. Both in the month have given very good results thanks to the oil price, making somewhat recovery. But both companies have reintroduced dividends at a higher level, and they've both started some kind of share buyback, so hopefully will improve greater growth moving forwards. And AJ Bell gave a very good trading quarter through the month. Q3 results: new customers up 30% to 368,000, and assets under management up 43% to 1.8 billion in new net flows in the month. Other companies we hold, so we say Pennon, AG Bar, John Menzies. Back down to our smallest company of Card Factory, we own £793, 1% of our portfolio. Hopefully moving forwards, somewhat recovery in the high street. Did sort its finances out, did have an issue of restructuring, but hopefully will be very cash rich moving forwards. Dividends will be reinstated. Special dividends may also be reinstated, but ultimately a long-term holding. So an overview of our shares. A lot of them are, shall we say, old established companies in the FTSE 100 for dividends, for growth and hopefully recovery plays such as the banking sector and insurance and the oil and gas, but also some growth companies moving forwards. JD Sports, Greggs, Card Factory, AJ Bar, the drinks retailer. Okay. So during the month of July, so we received some dividends, mostly the special dividend from Pennon, and we invested into the following companies. We purchased 34 shares in HBOS to increase our holding, value of £144. And with the Pennon special dividend, we put £700 into a US smaller companies. One, to increase our existing holdings, but two, the fund has fallen somewhat lately, so we have seen it as a good buying spree, or a good time to increase our holding in an existing fund. Now, if we move on to our funds, we own 6 funds in our portfolio. Okay, £19,047 makes up 20% of our portfolio, 6 in profit, none in loss. So just a quick overview of the holdings. Our largest holding is the Legal and General Technology Fund, £4,609, 5% of our portfolio, a very nice profit of 53% year to date. Our next shareholding, Summer Pacific, the Bally Gifford Positive Change, quite a select fund, has very few shareholdings but some great potential, up 39% since we bought it, £3,800, makes up 4.2% of our portfolio. Our next share of foreign holding is the US smaller companies, so we did increase this month. Now got a value of £3,480, nearly 4% of our portfolio, has reduced in value lately, but still showing a very nice profit since we bought it of 28%. Our next biggest holding is a UK growth fund, £3,380, 3.84% of our portfolio, making a profit to date 12%. And then we own a Lindsell Train UK equity. It's got a great track record in the UK the last few years through great long-term management. Owns a very number of small select companies, but all good established quality companies. Makes up £2,700 of our portfolio, 3%, up 8% since we bought it. And then our smallest shareholding is UK smaller companies, £1,090, 1% of our portfolio, up 8%. Moving forwards, I think the UK will have a great recovery in the sector, especially UK smaller companies, hopefully give us a greater return than larger companies, hence the reason we bought it. And we may well top up in future when the pandemic settles down and the UK recovery makes some kind of momentum building forwards. So if we look at the chart, shall we say, 6 funds, all in profit, all bought for long-term holdings, and the 6 funds are to give us some diversification, because our holding was predominantly UK based through our shares. So only recently, the past few months, we've actually started to diversify and create a more balanced fund. Well, hopefully through holding the funds and the growth shares and some of the dividend shares, it will give us our aims to make 10% growth year on year, and hopefully the dividends as required. Now, it's not a quick get rich quick portfolio. The idea is growth moving forwards. As we said, 10% year on year. We will have good months, we will have bad months, but at the moment we're exceeding our expectations. And hopefully moving forwards, we'll meet our aims and requirements. So, just a quick summary. Remember, if you like the videos, smash the like button and we'll see you again soon.